In 2013, a contractor walked out of an NSA building in Hawaii carrying 4 laptops and a collection of classified files on USB drives. Everyone called it the most catastrophic intelligence breach in American history. A year later, a startup in San Francisco had quietly built a data collection infrastructure 20 times more comprehensive than anything on those drives. They called it a free app. Nobody called that catastrophic. In 2015, the EU started drafting what would become the most aggressive data protection regulation in history. By 2018, when the law actually went into effect, the largest tech companies had collectively spent billions on compliance teams, not to comply, but to comply on paper while continuing to collect everything they always collected. The workarounds were documented, they were legal. Nobody went to jail. Right now, your phone has a statistical estimate of your annual income. Your credit card company has a behavioral model of your emotional spending patterns. A data broker you have never heard of, operating out of a nondescript office park somewhere, is selling a profile of you that includes your approximate net worth, your political lean, your health anxieties, your relationship status, and the first names of your children. The going rate for that profile is somewhere between 70 cents and $1.50 per person, per sale, and it gets resold. And your government, the entity with the constitutional authority to regulate all of this, knows less about your financial behavior than a mid-sized marketing firm in Atlanta. So the question is not whether the government lost the privacy war. That already happened. The question is, what does the world look like after that loss? And more specifically, what does it mean for how money actually moves? We are going to explain how the privacy machine works, who actually won this war, and why the financial implications of all this are significantly weirder than most people realize. The metaphor I am going to use throughout this entire video is a one-way mirror. For most of the 20th century, surveillance worked like a one-way mirror. On one side, the state sitting in the dark, watching. On the other side, citizens, illuminated, observable. The whole design of privacy law, surveillance doctrine, intelligence agencies, everything was built around that image. Power flows in one direction, the dark side watches the bright side. One-way mirror. That was the deal, and everyone basically understood it. Then the internet happened. Then the smartphone happened. Then cloud computing happened. And the mirror shattered, not because governments became weaker in some dramatic political sense, but because private companies, chasing profit incentives that governments simply do not have, built a surveillance infrastructure so vast, so efficient, and so perfectly embedded in daily life that no government program could match its scale, regulate it at the same speed, or meaningfully compete with it as a collection apparatus. And now we live in a world where the mirror is broken into 100,000 pieces, and in every shard you can see a different company looking back at you. And the government is somewhere in the pile, still looking for its reflection, occasionally picking up a piece and asking someone in tech to explain what it does. Here is the first thing most people get systematically wrong about government surveillance. They think it is sophisticated. They have seen the movies, the NSA in a cold server farm somewhere, intercepting every communication in real time, processing it all through black box algorithms, tracking every digital footprint. And some of that is real. The capability is real in certain narrow contexts. But structurally, the most revealing detail about the PRISM scandal in 2013 was not the surveillance itself. It was the method. The NSA's approach was to go to Google, Apple, Facebook, and Microsoft and essentially request access to data that those companies already had. In some cases with legal orders, in some cases through more informal arrangements. The government was not the primary collector of information. It was showing up, sometimes politely and sometimes not, at the back door of private corporations and saying, we would like to look at your database, please. That tells you everything about the actual power structure. Because what it reveals is that the real surveillance infrastructure was never being built by governments. It was always being built by private entities, not because Silicon Valley wanted to spy on you in any ideological sense, but because behavioral data turned out to be the most valuable commodity in the modern economy. The incentive was never political, it was purely financial. And financial incentives move faster, adapt faster, iterate faster, and scale faster than any government program in history. This is the thing the privacy debate keeps getting wrong. It frames the problem as government overreach, Big Brother, authoritarian creep. And look, that frame captures something real in specific contexts. But the deeper structural story is that governments built surveillance programs, got exposed, faced public backlash, and in some cases faced genuine legal consequences. Private companies built the exact same capability, monetized it aggressively, put it in an app store, and made you agree to it in a terms of service document you have definitely never read. They called it personalization. Nobody went to jail, because if the product is free, most people do not register, they are paying. And the regulators who were supposed to stop this were still trying to understand what a cookie was while the engineers were shipping version 11 of the tracking layer. Here is a number worth sitting with for a moment. By the end of 2025, the global data broker industry meaning companies whose entire business model is buying, processing, packaging, and reselling personal data profiles, had grown to an estimated $240 billion annually. 240 billion. That is more than the GDP of most countries in the world. And the raw material, the input they're processing and selling, is your behavior, your clicks, your purchases, your location history, your search queries at 11 at night, one-way mirror. The government built one and got caught. Private industry built 10,000 of them and wrote them into the terms of service. Now let's bring this closer to money, because this is where things get genuinely interesting. When most people hear the phrase your data is being collected, they picture targeted advertising. You searched for running shoes 3 days ago, and now every website you visit has running shoes somewhere on it, which is mildly annoying, easily ignored, and not obviously a threat to anything important. Most people land here and stop thinking about it. That is the consumer-facing symptom. It is the part they design to be visible because it is the part that is least threatening to understand. The actual story is happening inside your financial life, and the vast majority of people moving through the current economy are doing it completely blind to the underlying mechanics. Here is how the system actually functions. Your credit card company does not simply know what you bought. It knows the timestamp of every transaction, the merchant category code, the physical location, the size of the purchase relative to your 12-month average, the time elapsed since your last transaction, whether that transaction occurred on a weekday or weekend, and whether the timing pattern deviates from your established baseline. It builds a behavioral model from all of this data continuously in real time, not as an experiment. As a core revenue function, there are entire data science departments at every major financial institution whose primary job is to predict from your transaction history alone whether you're about to miss a payment, whether you're entering a period of measurable financial stress, whether you are likely to take on new credit in the next 60 to 90 days, and which product to surface to you with which messaging at which exact moment in your behavioral cycle to maximize the statistical likelihood of acceptance. The credit limit increase notification that appears in your app right after a higher than average spending month is not a coincidence. It is an output. The balance transfer offer that arrives precisely when your utilization creeps above 30% is not a coincidence. It is an output. These are the products of a machine that monitors your financial behavior continuously and optimizes its outreach to catch you at moments of measurable vulnerability. And I want to be precise here because I think precision matters. I am not arguing this is malicious in some cartoonish sense. I am describing a system with incentives, and those incentives are pointing entirely in one direction, which is not yours. The company offering you that product at that moment makes more money by timing it correctly than by offering it randomly. Your understanding of the timing pattern is not required for the transaction to happen. Now extend this beyond banking. Insurance companies are purchasing third-party behavioral data to supplement and refine actuarial models that used to rely only on declared information. In some markets, driving behavior data that you generated while using a maps application or a weather app, data you shared in exchange for a service, has flowed through a series of broker transactions and ended up informing your car insurance premium without any meaningful disclosure at any point in the chain. Your grocery loyalty card generates purchase data that eventually flows through several arm's length transactions into health-related risk models. The pattern of what you buy when you buy it, how it deviates from average, that becomes an input into systems that determine the cost of financial products you would apply for years in the future. And here is the reversal, the one I want you to actually hold on to. You think the problem is that your data is being used to show you ads, but the real problem is that your data is being used to price your life. The interest rate on your next credit product, the premium on your insurance policy, the mortgage terms you get offered and the ones you do not, the job applications that advance and the ones that do not. All of this runs to a degree that is increasing year over year through behavioral data models that you have no visibility into, no ability to audit, no meaningful right to contest, and no realistic mechanism for correcting if the underlying data is wrong. That is not a privacy inconvenience. That is a structural financial disadvantage, and most people are experiencing it every single week without any framework for understanding why things feel slightly tilted against them. If you are building wealth or actively trying to, this is the kind of structural reality you need to understand. Not theoretically, practically. I make videos about how money systems actually work, who controls them, and how to position yourself correctly relative to them. Not emotionally, but mechanically. Subscribe if that is useful to you. I don't sell hope, I explain structure. Now let's go to the third layer, the one that even financially sophisticated people tend to miss, and it has everything to do with payments. Most people think of the payment system as neutral infrastructure. You have money. You transfer money. The thing that processes the transfer is a pipe. Boring, technical, invisible, not particularly relevant to the conversation about privacy. Here is what it actually is. Every transaction you execute through a card network, a bank transfer, a payment application, a buy now, pay later service, every single one of those creates a time-stamped, identity-linked data record that is retained indefinitely and is legally accessible to government entities under a range of conditions considerably broader than most people have ever been told. The Bank Secrecy Act, passed in 1970, requires financial institutions to report specific transaction patterns. The thresholds and categories of reportable activity have expanded significantly across the decades since then. The number most people have heard is $10,000. Transactions above that trigger automatic suspicious activity reports. What most people do not know is that a practice called structuring enforcement means that multiple transactions below the threshold can also trigger reporting if the pattern suggests the amounts were deliberately chosen to avoid that limit. The threshold is not a flaw, it is a tripwire. The point is that the payment system was from its inception designed to be a surveillance instrument that also moves money. The order of priority there is not a typo, and then two things happened that changed the terrain dramatically. The first was the collapse of cash. Cash has been declining as a percentage of consumer transactions in most developed economies since the early 2000s. In 2008, cash represented roughly 40% of consumer transactions in the United States by volume. By 2025, that number had fallen to somewhere in the low teens, and in several categories, online purchases, large retail subscriptions, it was effectively zero. Cash did not disappear because of any law. It disappeared because digital payments were more convenient, and humans reliably trade long-term structural costs for short-term friction reduction. Every time. The effect of this shift is that the one financial tool that leaves no record, the only payment method that is genuinely outside the surveillance perimeter, quietly became impractical for daily use. Not through legislation, through habituation. The surveillance net got tighter by default, one tap to pay transaction at a time. The second thing that happened was crypto. Bitcoin appeared in 2009. Everything that followed. And governments looked at decentralized digital currency and saw exactly what they feared. A payment system that could operate outside the financial surveillance perimeter that every previous payment infrastructure sat inside, which is why the regulatory response was immediate and broad and has been continuously expanding ever since. KYC requirements at exchanges, mandatory tax reporting, attempted restrictions on self-custody. The goal was always to pull crypto transactions back inside the perimeter where existing tools work. Whether that has succeeded is, as of early 2026, genuinely contested. In some jurisdictions, and for most users, yes, the on-ramps and off-ramps to fiat currency bring enough identity friction that the surveillance net captures most of it. But the technical capacity for genuinely private financial transactions has also increased. Zero-knowledge cryptographic proofs, private transaction protocols. The tools are real and they are improving. The law is behind the tools. That gap is not closing as fast as the regulatory bodies would like. This is not a recommendation to do anything in particular. It is a description of a moving boundary, and the shape of that boundary determines a significant amount of financial opportunity over the next decade. Let me give you a concrete scenario to make this tangible. Two people, same income level, roughly $200,000 a year, both in their late 20s, both working in professional contexts, both reasonably intelligent about money in the way that most people who have a savings account and a 401k consider themselves reasonably intelligent. The first person treats financial privacy as irrelevant. Every financial account is linked to every app that asks. Every loyalty card is in the wallet. Credit cards are used for everything, which is actually smart for points, but the resulting transaction history is dense, behaviorally rich, and full of variance. There are months of clearly elevated spending. There are late payments on 2 occasions, both minor, both quickly corrected. There are several buy now, pay later arrangements from a period of enthusiasm about furniture. There are subscriptions that started, lapsed, restarted. The behavioral profile from a data modeling perspective is highly legible. There are interesting edges. There are exploitable patterns. Over 5 years, this person is offered and accepts 3 balance transfer products, 2 credit limit increases, and 1 personal loan refinancing arrangement that extended the repayment period in a way that seemed favourable at the time but increased total interest paid. Each offer arrived at a moment of measurable behavioural vulnerability. Each one made financial sense to the company making it. The total cost in interest and fees over those 5 years is approximately $17,000. The second person is not paranoid. They are just structurally deliberate. They use a small number of financial accounts with clearly separated purposes. They pay credit balances in full on the same day each month on a fixed schedule using automation. Their spending variance is low, not because they spend less, but because the pattern is consistent. They opted out of data sharing wherever a real opt-out existed, and wherever doing so cost them nothing meaningful. They use loyalty programs, but limited ones. Their financial behavioral profile from a data modeling perspective is boring, predictable, no stress signals, no anomaly windows, no interesting edges to exploit. Over the same 5 years, this person pays zero in consumer interest. Their insurance rates have not moved in response to external data signals. They have been offered fewer products at less aggressive terms because the system cannot locate a clean entry point. Their financial profile is, to the pricing algorithm, not worth spending much optimization budget on. And they kept those 17K, not through earning more, through being invisible in the right way. $17,000 is not a transformative sum in isolation, but the compounding effect of not being extracted from continuously across 20 years is substantial. And more importantly, the behavioral discipline that produces a boring financial profile tends to correlate with other wealth building behaviors. The boring profile is usually a symptom of something structural, not just a privacy choice. The one-way mirror works best when the room it is looking into is brightly lit. If you dim the room slightly, not darkness, just less signal, the image degrades. The algorithm needs signal to price you. Denny it, signal, and it moves on to someone easier. Let me take a brief detour here. I want to describe the average response to information like this. Someone watches a video about data collection, nods seriously, says something like "that's genuinely wild," then immediately opens a new tab and clicks agree on 4 cookie consent banners in a row without looking at them, and downloads a free flashlight app that wants access to their contacts, microphone, and precise location for the flashlight. I am not judging the behavior. I am describing an incentive gap. The cognitive recognition that data collection is happening and the behavioral change required to respond to it are two completely different events in a human brain, which is incidentally exactly why the system is designed the way it is. You can be fully informed and still fully legible. Information alone does not protect you. Structural change does. And structural change requires doing something different exactly once, automating it, and not thinking about it again. This is the thing that makes behavioral data collection so robust as a business model. It does not require that you are unaware. It just requires that awareness is cheaper than action for most people, most of the time. Now let's get to the fourth layer. The one that most people who consider themselves financially literate, and even most people who follow this topic closely, have not fully processed. The government lost the privacy war. That is the headline. But who actually won it? Here is the counterintuitive answer. Nobody who was supposed to. The entities that won are not governments. They are not privacy advocates who spent decades warning about exactly this outcome. They are not even necessarily the largest tech companies in the obvious sense, because those companies now face a new structural problem. Their data collection capacity has outrun their monetization efficiency, and regulatory enforcement, while still slow, is meaningfully accelerating. The fines are getting larger, the legal exposure is increasing, the reputational cost in certain markets is real. No, the entities that genuinely won the privacy war are the ones that understood early, years before the mainstream conversation caught up, that data scarcity was ending. That the question was not whether your data would be collected, because it would be. The question was who would own the infrastructure through which that data flows, who would control the processing layer, and who would be positioned on the correct side of the mirror when the inevitable market consolidation happened. This has created what I think of as 3 levels of positioning relative to the data economy. Not 3 types of people, 3 structural positions that individuals and capital can occupy. Level 1, you are a source. Your behavior generates data. That data is collected, processed, and monetized by others. You receive none of the economic upside. You receive some of the downside in the form of financial products that are priced precisely against your behavioral patterns. You are the input. Approximately 90% of people in the developed world are sitting at level 1, most of them without a working vocabulary for understanding it. Level 2, you are a deliberate user. You understand that data collection is happening, and you use that understanding to make better structural decisions. You are less legible to the machine, not invisible but boring. You pay less in aggregate over time. You are not generating outsized returns from the system. You're simply not being extracted from as efficiently. This is where maybe 8 or 9% of people are, mostly by accident rather than intention. Level 3, you are positioned on the supply side of the infrastructure. You own equity in or have direct economic exposure to the companies, technologies, or platforms that sit in the flow of data itself. When data collection increases, you benefit. When privacy tools gain adoption, you benefit from those too, if your position is correct. When regulation changes the economics of the playing field, you understood the second order effect and moved before the market consensus formed. Most people who believe they are at level 2 are at level 1. Most people who believe they are at level 3 are at level 2 at best, holding the popular names that everyone already knew about. The gap between these 3 levels is not primarily an information gap, it is a structural positioning gap. And it compounds. Let me be specific about where that 3rd level actually looks interesting right now, because vague insight is worth nothing in practice. The data economy runs on a stack, At the bottom is raw data, behavioral signals, transaction records, location history, biometric patterns. Above that is the processing layer, the algorithms, models, and compute infrastructure that transform raw behavioral signals into actionable profiles. Above that is the application layer, the financial products, insurance adjustments, hiring decisions, and advertising that operate on those profiles. And above all of it sits the regulatory and legal layer that, in theory, governs the whole stack. For most of the 2010s, the largest returns were concentrated in the middle two layers, processing and application. That is where the major platform valuations were constructed. That is where the trillion-dollar companies emerged. But the terrain shifted meaningfully starting around 2022, 2023, and the shift has accelerated into 2026. The regulatory layer is moving faster than it was. GDPR enforcement in Europe became materially more aggressive. The FTC issued fines that were actually large enough to register as business considerations. State-level privacy legislation in the United States passed in enough jurisdictions that compliance became a real operational cost. And simultaneously, AI made the processing layer both vastly more powerful and significantly more accessible, meaning the competitive moat of having proprietary algorithmic capability became narrower because the same tools are available to anyone with a cloud account. The economic value is migrating. It is moving towards two specific places. First, toward the infrastructure layer, the pipes, not the water. The companies and systems that own the actual data routing, storage, identity verification, and compute infrastructure, regardless of what flows through them. Infrastructure businesses tend to win from volume regardless of content. When data volume increases, infrastructure wins. When regulation increases compliance requirements, infrastructure that enables compliance wins. This is a structurally advantaged position that does not depend on picking the right application. Second, toward the privacy technology layer, the tools, protocols, and platforms that allow data to be used without being fully exposed. Techniques like differential privacy, zero-knowledge proofs, and federated learning are not new concepts in 2026, but they are newly at the stage of serious enterprise adoption. These tools solve a specific problem. How do you derive the value of a data set without creating the liability of holding it? That problem has a very large and growing market willing to pay for a solution. The reason this matters financially is almost entirely second order. Most investors and most observers look at the privacy debate and identify risks. Regulatory risk, reputational risk, technology disruption risk, which is correct at the first level of analysis. But the second order effect is that every regulation that restricts the current data extraction model simultaneously creates demand for a compliant alternative. The market does not stop wanting to use behavioral data. It just needs a new mechanism for using it without the fine attached. And the companies building that new mechanism are, relative to where they will be in 5 to 8 years, undervalued right now. This is the same structural pattern you see with every major regulatory shift in a high-value industry. Environmental regulations created the clean tech industry. Financial regulations after 2008 created the compliance technology industry. Healthcare privacy regulations created an entire sector of secure data infrastructure. Privacy regulation is right now in the process of creating the privacy technology industry. You can hold a moral view on whether the original problem should have been prevented. Separately, you can decide whether you want to be positioned on the right side of the solution. The one-way mirror shattered. The pieces are still on the floor. Some of them are sharp. Some of them are valuable. The question is only what you do next. A second brief aside. Someone in the comments will suggest that the real move is to delete all social media, move somewhere rural, use only cash and grow your own food. And look, I understand the instinct. It has a certain philosophical coherence, but cash is a declining percentage of transactions even in rural economies. The permit for the land still requires a government portal, and the farming equipment is financed through a system that reports to the same financial infrastructure we have been discussing for the last 20 minutes. The point is not to exit the system. The system does not have an exit door that is both available and practical. The point is to understand the system you are actually in and to occupy it deliberately rather than passively. The practical wins in this space are structural, not dramatic. They take an afternoon to implement and then run quietly in the background indefinitely. That is a much better return on the effort of understanding this stuff than any dramatic lifestyle change. Here are 3 specific things, and I want to be precise because general advice is a waste of both our time. The first is to reduce your behavioral signal variance. The machine that prices your financial life is looking for anomalies, stress indicators, vulnerability windows, deviations from your established baseline that suggest a moment of susceptibility. The mechanism for reducing its ability to exploit those windows is not to hide everything about yourself. It is to produce consistent, boring, predictable financial behavior at the pattern level. Automate your savings transfers on a fixed schedule so they do not vary. Pay balances on the same day each month without exception. Use credit in a pattern that does not oscillate seasonally. Eliminate the lapse subscriptions that create noise in your expense pattern. The behavioral data you generate becomes dull to model. And dull is exactly what you want to be. The pricing algorithm cannot optimize against a flat line. It looks for edges, remove the edges. The second is to understand that data privacy is now an asset class, not just a social concern. This means paying attention to where regulatory and technical landscapes are moving and positioning relative to those movements. The privacy legislation wave that originated in Europe is working its way through US state legislatures at an accelerating pace and into other major markets. Every time a new restriction passes, a compliance market opens and the companies serving that market become more valuable. Every time a privacy-preserving technology gains adoption, the infrastructure enabling it gains economic significance. You do not need to be a professional technology investor to benefit from understanding this pattern. You just need to not be surprised when the second-order effects arrive, because the first-order effects are already visible. The third thing, and this is the one with the most long-term compounding value, is to stop being surprised by incentive structures. The data economy is not a coordinated conspiracy. It is a set of aligned financial incentives that produce predictable behavioral outputs from the rational actors within it. Companies collect your behavioral data because it increases their revenue. Governments access that data because it serves their intelligence and enforcement functions. Regulators respond slowly because the institutions they regulate move considerably faster than legislation can follow. None of these actors are primarily villains. They are primarily optimizers. Understanding them as optimizers is significantly more useful than being angry at them as villains. The person who understands this is not outraged by the system. They are positioned within it deliberately. They capture more of the upside, absorb less of the downside, and make fewer decisions that the system was engineered to push them toward. Outrage is expensive. Understanding is cheap. The difference in financial outcomes between these two responses, compounded across a decade, is not small. Let's come back to where this started. A contractor walked out of a building with a hard drive. The world called it the most catastrophic privacy event in modern history. Meanwhile, a free app was shipped, and then another after that, and each one of them collected more data than the hard drive ever held. Nobody called those catastrophic. They called them growth. The government lost the privacy war not because it was outgunned in any dramatic sense. It lost because it was optimizing for political power, while private industry was optimizing for money. And in the information economy, those two incentives pointed at exactly the same capability, mass behavioral surveillance, but the financial incentive moved faster, scaled larger, and embedded itself more completely into daily life before the political and legal framework could respond. The one-way mirror, which was supposed to give power as asymmetric view of citizens, got replaced by something more efficient. A system where you hand over your reflection voluntarily, continuously, in exchange for services that are almost always worth slightly less than what you gave. That system is not going anywhere. It is getting more sophisticated. The processing capabilities are getting better. The applications are getting more precise. And the regulatory response, while real, is building a compliance layer that will likely produce the next generation of privacy infrastructure companies rather than actually reversing the underlying dynamic. Which means the only real question is which side of the infrastructure you occupy. Most people are a source in this system. A few people are deliberately boring to the machine. And a smaller number understand that the mirror is broken, figured out which pieces are worth picking up, and positioned accordingly before the rest of the market understood what they were looking at. The one-way mirror is gone. You are in both rooms now, whether you think about it or not. The difference between outcomes in this environment is almost entirely determined by whether you mapped the room before you started moving through it. If this kind of thinking is useful to you, subscribe. I am not going to tell you to believe in something. I am going to keep explaining how the systems actually work.